Good afternoon, everyone, and welcome to today's webinar on refinancing, what counselors need to know. My name is Lindsay Burns, and I'm a lead housing counseling specialist at ICF, and we are so glad you could join us virtually as we discuss the strategies for refinancing and the challenges homeowners face when refinancing their homes. This webinar is brought to you by the Office of Housing Counseling. Before we begin, let's cover a few Zoom logistics to ensure a smooth experience. Participants, you are in listen-only mode. If you do experience any technical difficulties, please submit a message through the chat box directed to the Zoom host. The chat box icon resembles a small speech bubble located at the bottom of the Zoom window on the toolbar labeled Chat. For content-related questions, you can use the Q&A box at any time. The Q&A icon resembles two speech bubbles located at the bottom of the Zoom window on the toolbar labeled Q&A. You can also send your questions to housing.counseling@hud.gov before and after and during the webinar. This webinar is being recorded. The recording, transcript, and slides will be available within 7 to 10 days on the HUD Exchange. And to add this course to your transcript on the HUD Exchange, you can click the Get Credit button on the webinar training page. You must have a HUD Exchange account to receive credit. Lastly, the presentation materials were emailed prior to the webinar, including a new job aid for housing counselors on refinancing basics. Those materials have also been posted on the HUD Exchange. Now that we've covered logistics, let's review today's agenda and the key topics we'll be discussing. Today, we will cover an introduction to refinancing, financial considerations, eligibility and requirements, the refinancing process, refinancing options, risks and considerations, HUD requirements and reporting. And then we will have a conversation with two housing counseling agencies, special guests, regarding refinancing and their experience. We will wrap with some resources and tools and time for questions and answers. Before we move into today's presentation, it is my pleasure to introduce Gerald H. Mayer, Director of HUD's Office of Outreach and Capacity Building. Jerry will provide a welcome to today's conversation. Jerry?
Hi, everybody, and thank you, Lindsay. I'm Gerald Mayer, and I'm the Director of the HUD Office of Outreach and Capacity Building in HUD's Office of Housing Counseling, and welcome. Today, we're going to be talking about refinancing. And this is an important topic for housing counselors as interest rates rise and fall. We have clients that seek to refinance their homes, and they naturally turn to HUD-certified housing counselors for advice. Today, we're going to be joined by a panel of experts in the field of housing counseling and who are knowledgeable about refinancing. And so without further ado, I'm going to turn the mic back over to Lindsay, who's going to take us through the rest of today's program.
Thank you, Jerry, for the warm welcome. As Jerry mentioned, we are honored to have two distinguished speakers with us today. We have Judy Ayers-Britton, who is a housing counseling consultant with Ayers-Britton Consulting, LLC. Judy brings a wealth of experience in housing counseling and HUD regulations. We are also going to hear from Jason Zavala, who is president at Mitigate Incorporated, which is an affordable housing specialist who provides professional training, facilitation in pre and post-purchase education, consumer finance, and housing counseling, and provides compliance monitoring services through national intermediaries. So welcome to Judy and Jason. Now, we can get the conversation started with a couple of feedback and polling questions using Mentimeter. You will find the Mentimeter link along with the access code located in the chat box, which is located in the bottom of your Zoom window on the toolbar labeled Chat. The time for Mentimeter icon, the blue circle with the graph inside it to the right on my screen, is your cue to visit www.menti.com on your computer or smartphone. Now for our first polling question. Please join us at menti.com using code 6971215 or following the link in the chat box. And our first question for you is, how familiar are you with refinancing as a housing counseling organization, staff person, counselor? Where options are very familiar, somewhat familiar, or not familiar at all. We are looking to reach all of you today. And it looks like we have a great substantial portion of the audience who are somewhat familiar with refinancing, and that could be through various means, as well as a good portion who are very familiar. So we hope that we can continue to share information across the housing counseling agencies based on all of your good experience and orient those of you who are not familiar at all. We're landing at about 14 with the refinancing process and the basics that you need to know as a housing counselor. So we have 38, 39 folks very familiar, 86 somewhat familiar, and 14 not familiar at all. It's a great distribution. Our second question is, have you encountered clients who have needed assistance with refinancing? We know in the course of your housing counseling work, folks may come in with a number of different challenges or situations that they are looking for your assistance with. And refinancing may not be obvious or may not be one that they always bring up, but it may come up in the course of the work, or they may come to you looking for advice. So it sounds like from the results that are coming in so far, the vast majority of you occasionally encounter clients who need assistance with refinancing, whether that's pre or post purchase. And a good number of you also have said, no, not yet. We anticipate with the way interest rates are going and the way the market is changing, folks may be reaching out for information. So now's a great time to get familiar. For the 14 of you who have said that, yes, you frequently encounter clients who have needed assistance with refinancing, we're certainly glad to hear that, and we'll love to hear your feedback after today's webinar. So we've landed at 34 who have not had experience with clients needing assistance with refinancing yet, 15 who have frequently assisted clients or encountered clients on refinancing, and 92 who have occasionally encountered clients who need assistance with refinancing. Our last question is, which refinance topics have your clients most inquired about, if they have inquired about refinancing? Some of the options that we anticipated you might be asked about include product options, reasons to refinance, financial implications, process to refinance, or perhaps other more in-depth topics. And all of our bubbles are firing in now. Great participation from our audience. I'll let these bubbles build up on the screen for the various responses. It looks like we're seeing most of you who have worked with clients on the topic of refinancing have had clients inquire about financial implications, which makes sense as folks are looking to the housing counselor for advice on how to manage their mortgage payment. But also folks are wondering about the process. How does it work? How did it get started? Which is great to hear because we know there's a lot to go through, as you'll see through today's webinar. Reasons to refinance seems to also be a very popular topic clients inquire about. For those of us who may be newer to home ownership and clients who are sort of understanding the whole process of homeownership as they go along, there's a lot to know about how it could benefit them and why they should consider it. And we've also seen folks have inquired about product options, as those can get very detailed, very specific. Often there's direct marketing campaigns about specific product options. Good portion of those topics also fall under other. We have about 12 responses now for other. So again, something that we're interested to hear from you all about in terms of topics that after today's webinar, we may want to peel back further. Great. So we're landing at 51 who have responded about financial implications, 32 who have responded about process, 27 who have responded about reasons to refinance, and 23 who have responded about product options. I'm now going to turn it back to our presentation. You can continue to respond to the Mentimeter poll and move us into our introduction to get started on refinancing. Please join us, Judy Ayers-Britton, to discuss the introduction to refinancing.
Thank you, Lindsay. Great Mentimeter questions. Good afternoon, everyone. It's an absolute pleasure to be here today to speak with all of you on refinancing. So let's get started with an introduction to refinancing. Introduction, we can move on to the next one, the introduction. So this slide contains 3 introduction to refinancing questions. The first is, what is refinancing? Refinancing is the process of replacing an existing loan with a new loan, typically to achieve a better financial term, which may result in lower interest rates, reduced monthly payments, or even a different loan term. What is the purpose and how can refinancing benefit your clients? Refinancing can be used to change the client's current interest rate. They can change the term from a longer loan term to a shorter one, such as from a 30 to a 15-year mortgage, to pay off the loan faster and save on interest. Homeowners can access their home equity to borrow more than they owe or their current on their current mortgage, providing cash for expenses like home improvements or debt consolidation, or change from an adjustable rate mortgage to a fixed rate mortgage for more predictable payments. In general, clients can put themselves in a much better financial position by refinancing. So let's look at some of the financial considerations. Refinancing considerations. On this slide, you have 5 financial considerations to think about when refinancing. Let's start with closing costs and fees. There are costs associated with refinancing, of course, which need to be taken into consideration to make sure refinancing is right for your client. And what's the impact on their credit score? As you know, just like purchasing, lenders do a hard inquiry on their credit that can affect your client's credit score. It's best to shop around within a short period of time, so credit bureaus treat it like a single inquiry, minimizing the impact. When you refinance, you close the original loan and open a new one. This affects the average age of the client's accounts, which can lower their credit score temporarily, especially if the new loan is significantly younger than the previous one. If the refinance puts your client in a better financial position, it can positively impact their credit utilization and could help them pay off their other debts, which will have a long-term positive impact on their credit score. Refinancing to consolidate debt can improve your client's score by reducing the number of accounts with outstanding balances. However, you want to stress to your clients to not utilize the new available credit, as this could just get them further in debt. Refinancing to consolidate may not always be a good use for some clients. Any negative impacts of refinancing is temporary and should diminish within a few months, and the positive impacts can outweigh the negative ones. Let's look at tax implications. You should also discuss any possible tax implications with your clients. It's a good idea to have them consult with a tax professional. Tax laws are complex and subject to change, so professional advice ensures compliance and maximizes benefits. Debt to income ratios can also be affected. Refinancing can affect their ratio, which is, as you know, is a key indicator used by lenders to assess their ability to repay the loan. Some things to consider are if your client refinances a mortgage with a higher interest rate or shorter term into a lower interest rate or longer term, the new payment could be lower, thereby reducing the client's overall monthly debt load and improving their debt to income ratio. If your client is consolidating debt or taking out equity, you need to make sure the ratios are still in line with the lender's requirements. If they exceed what is acceptable, the loan may not be approved. So what is the effect on down payment assistance programs? Since many of your clients are first-time home buyers and some are low to moderate income, they may have received down payment assistance or DPA. And many DPA programs are structured as loans, either deferred or forgivable, rather than grants. These loans may require repayment if your client refinances. Read through the DPA docs carefully to make sure your client is complying before recommending a refinance. In most cases, if the refinance puts the homeowner in a better position and they're not taking out cash, the provider of the DPA program will subordinate. I suggest reaching out to the organization that provided the assistance to discuss refinancing options and clarify any restrictions. Refinancing with DPA in place can be done, but understanding the specific terms is crucial to avoid any unintended financial obligations. So mortgage insurance premium, or MIP, and private mortgage insurance, or PMI, refinancing can impact MIP for FHA loans and PMI for conventional loans. And in some cases, it can even allow you to eliminate these costs. MIP can only be removed if your client refinances out of an FHA insured mortgage. MIP remains on an FHA insured mortgage for the life of the loan. If your client wants to stay with an FHA loan but refinance to a better rate, you'll likely need to pay a new upfront MIP. However, monthly MIP rates are often lower if the loan balance is smaller. This can slightly reduce your client's monthly payment. PMI, on the other hand, can be removed if the value of the home has increased or your client has paid the loan down and the refinance will bring their loan to value below 80%. One note here, though, once the loan to value drops to 78%, the lender will automatically remove the PMI. If your client needs PMI on the new loan, the cost of PMI could differ based on your client's credit score, debt to income ratio, and the loan type. Sometimes refinancing can lower your PMI payments if your financial situation has improved. Now that we understand what refinancing is and we've covered the financial considerations, let's look at all the eligibility and requirements for refinancing and discuss how housing counselors can provide the best guidance to their clients. So refinancing requirements. On this slide, you'll find 2 requirements for refinancing with details on what qualifications are and what documentation is needed. Let's start with the loan qualifications. Loan qualifications vary depending on the type of loan your client chooses. Just like a purchase, the lender is going to look at your client's credit, income, and the equity in the property. The documentation needed will be based on the loan type, but will mostly include personal identification, financial statements, current mortgage information, and other information the lender requires to approve the loan. Now, I'd like to turn it over to Jason Zavala to talk about the refinancing process.
Thank you, Judy. Greetings, everyone. So let's talk about the refinancing process. On this slide, you'll find a graphic with 7 squares that depicts the steps to the refinancing process. From left to right, we start first with identifying your client's financial needs as the starting point. This should be common for any counseling session. It is ideal to identify baselines to be able to align to potential solution sets. This could include capturing their outstanding balances and current rate and terms, perceived financial benefit sought, possibly expressed as monthly savings, financial distress to be resolved, or repairs and improvements sought. Once we know their financial needs, next we assess product options for viability. For example, urban properties will preclude loan products with rural requirements. Adverse credit use could inhibit cash out options, and high debt loads or limited equity could also pare down options. In all, there should be an identifiable net benefit. A lower rate loan in and of itself may not be enough to gauge appropriateness as a solution. When your client has determined options that can align with their needs, then they should research a few originators of interest and initiate the loan application. Notable to this third step, a 30 to 45-day period is common to complete this effort once that application has begun. In addition, your client will need to decide whether to lock in a rate. This term and action simply reflects their interest in securing set pricing at the time of application. If the market appears to exhibit volatility that could potentially move their rate in a more desirable direction, they might consider letting it float. The caution is that volatility could cast them in the opposite direction, and they might miss an opportunity by chasing hopeful rates. For the loan sources that we are examining today, clients will be required to provide supporting documentation for underwriting. These are the same validating, verifying items that were provided at purchase. Once your client has tended their obligations to initiate this process, a home will typically undergo some type of current value assessment to validate a loan. It is at this point when an originator will schedule and obtain an appraisal, as noted in the sixth square. As a variation to purchase transactions, the appraisal may not require on-site assessment, and the client should note and provide any upgrades that could impact improved valuation and thus potentially equity position. Some sources like FHA, VA, and USDA may not even require this step, depending on the loan program. And finally, it's off to close the loan. Here, your client will likely engage in considerably less complicated transaction than their initial closing. There is no real estate professional or buyer or buyer's representatives involved, so the closing coordination will likely only be with title or attorney services and thus more expeditious. The notable variance is that your client might have a right of rescission protection option, typically not included refinancing with their current lender, should they find that the implications suggest that a hasty decision or unforeseen pitfalls exist. Often this is triggered if they execute the refinance under duress, fraud, by mistake, and/or inadequacy of consideration. This action is executable for the 3 days following closing or after key disclosures or notices are provided. Next slide, please. So now let's talk about refinancing options. On this slide, you will find a Venn diagram that expresses some differences between Fannie Mae, Freddie Mac, FHA, VA, and USDA loans. These are the most common financial platforms used in refinance, and some conditionals that are unique to many of the products that they represent. This is a simplified representation of product variability and helps to show loan options consider many components. Note, some features, such as rates, are subject to change as market conditions fluctuate. In 5 circles, starting in the upper left-hand side, we start with Fannie Mae. Broadly speaking, their refinance options will have a max LTV of 97%. As an example, if your client seeks an LTV greater than 80%, it would trigger private mortgage insurance, PMI, which has an annual cost ranging from approximately 0.5 to 1.5% of the loan balance. The range varies depending on conditionals like LTV, credit scores, and loan size and type. These products require an appraisal, and cash out could be allowable. We then examine Freddie Mac in the circle below it. Their refinance options will similarly have a max LTV of 97%. And if your client seeks an LTV greater than 80%, it would trigger PMI with annual cost, again, ranging from approximately 0.5 to 1.5% of the loan balance. It will also require an appraisal, and cash out could be allowable. For both Fannie and Freddie refinance options, their products can be described as best for 700 plus credit scores and are likely to require at least 5% funds for closing. Now let's consider the center circle that shows FHA, a product identified for being best for credit scores at 600 or greater. Their options have a max LTV of 96.5% and include 1.75% of the base loan amount for the upfront mortgage insurance premium, UFMIP, plus an estimated 0.8 to 1.5 of the loan amount for the monthly mortgage insurance premiums, MIP. It will require an appraisal, and cash out could be allowable. Conditions apply to 203K loans, regular or streamlined loan products. Regular refinances require full documentation, whereas streamlined considers reduced documentation. We then examine VA sourcing in the upper right circle. Their refinance options have a max LTV of 100%. Though there is no MI, the comparable costs as a funding fee could range from 1.4 to 3.6%. It will also require an appraisal, and cash out could be allowable. USDA in the fifth circle in the lower right represents our last refinance example that has a max LTV of 100% and requires MI. Costs could include an upfront 1% guarantee fee and 0.35% annual fee based on the unpaid principal balance. It will also require an appraisal, but cash out is not allowable. VA loans are best for qualified veterans with valid certificate of eligibility. USDA loans are best for clients with 640 plus credit score and living in a rural area with income less than 115% AMI. Unlike Fannie or Freddie, both VA and USDA allow for no down payment. Again, this is not an exhaustive list and is a snapshot in time. Broad concepts like mortgage insurance that Judy introduced have variability of application amongst programs and products. And the representative bands for premiums and fees are subject to shifting based on periodic market conditions. Additional counseling guidance should also be considered for home equity conversion mortgages and other niche applications as clients and/or market conditions change. Next slide, please. So on this slide, you will find 3 bulleted alternatives to refinancing. Let's start with home equity loans and home equity lines of credit. These are not intended as an exhaustive list either, just more common alternatives to refinance options. Ultimately, your client may identify that refinancing their existing mortgage is not conducive to their needs and/or the benefits do not outweigh the risk. If this is the case, they might want to pursue a home equity loan. This would be a second mortgage with different terms and rates that would be subordinate to the existing first lien. These are usually a fixed rate and would not trigger additional mortgage insurance components. However, the rates tend to be higher and the term shorter. Like this, another option might be a line of credit that would have an adjustable rate and is commonly used when the amount needed is imprecisely determined. It allows for partial draws and commonly considered for renovation projects or debt consolidation. These paths can often be quicker and less onerous to transact, but ultimately could be more costly. Again, clients should consider both initial transaction and long-term costs. The next bullet identifies local, state, and federal options. These are often accessible through home rehabilitation or disaster recovery related loans or grants, and might have income limits or home type parameters to be met. State housing finance agencies may have periodic resources to support these interests, and occasionally local nonprofits might, independently or in conjunction with HFAs or federal programs, facilitate loans and grant mortgage refinance related resources. Lastly, we recognize that some clients' needs will fall outside of the underwriting parameters of the more common housing loan options and will need other alternatives. Programs should be able to identify personal loan type resources that may or may not encumber the properties. It's a big pond of options. So I'll now hand things back over to Judy to talk to us about risks and considerations.
Thank you, Jason. So now let's move on to risks and considerations. This slide shows risks and considerations, and on this slide, you'll find 3 things to consider when refinancing. Let's start with some potential pitfalls. What are some of the potential pitfalls or just things your client should consider when refinancing? If they extend the loan term, it will take longer to pay off the mortgage. Is that something they want to do, and does it make sense for your client? Are the closing costs and interest rates reasonable? If they aren't, you may want to discuss alternatives or suggest they wait to refinance. Market fluctuations. As Jason said, should they lock in the interest rate before closing so it doesn't change? Refinancing generally doesn't require a change in homeowners insurance, but it may lead to updates in lender information, coverage adjustments based on new lender requirements, or even an opportunity to review and potentially reduce the premiums. Refinancing itself doesn't directly impact real estate taxes either, but it can affect your client's escrow payments, lead to a refunded escrow balance, which is be a good thing, and in rare cases, indirectly influence future tax assessments based on appraisals or home improvements funded through cash out refinancing. So timing, how do you know when it's a good time to refinance? Is now the best? You should talk through current conditions with your client to determine if if this is the right time for them. I think when you talk through these risks and considerations with your client and create an action plan, it'll help you determine the answer to these questions and help your client make the best decision for them. What about possible scams? Make sure your client is aware of the scammers out there. Some of the things you should discuss with your client and look for in offers they share with you are unsolicited offers via phone, email, or letter. Make sure your client knows that they should find their own loan. You don't want them to think that the perfect loan is going to find them. It's important to compare offers to look for unacceptable fees and high interest rates. Look for hidden fees, such as upfront fees for processing, lenders pressuring to act quickly or guaranteeing loan approval, prepayment penalties, bait and switch offers, possible title scams, low-cost insurance policies that don't provide what the client needs. Your clients also need to be aware of the different platforms that say they're there to help the client, but they're really just there to promote their own products and services. They make it easy for the people using the platform, but is their product the best option for your client? The scammers are very creative, and that is why we need to get in front of these homeowners before the scammers do. Now let's talk a little bit about what HUD requires for reporting on the 9902 and how your file should be documented. HUD requirements and reporting. On these slides, you'll find a list of HUD reporting options based on the 9902 report. But before we go into reporting on the 9902, let's discuss file documentation. So what documentation is needed to be in a refinance file? As with any HUD client file, you'll need to document these files with a budget, financial analysis, action plan, client log, results of counseling, monitoring, and termination, including follow-up post refinancing. So where are you going to account for these clients on the 9902? 9902 reporting. HUD would like you to report these clients in Section 9, one-on-one counseling under pre-purchase or post-purchase, whichever makes sense for your agency, or Section 8, group education, when appropriate. Most likely you'll use Section 9 unless you have a workshop on refinancing for groups. For impact and scope, Section 10, outcome of counseling services. The most common outcomes would be households who B, received info on fair housing, fair lending, and or accessibility rights. C, developed a budget customized to current situation. D, improved their financial capacity. E, gained access to resources to improve their housing situation. O, were able to improve home conditions or home affordability. And P, prevented or resolved a forward mortgage default. These are the most common, we think. You may have other impacts on certain clients and need to report them in other areas of Section 10. It's important to show every impact you had on each client. So now let me turn it back over to Jason for a very engaging conversation with a couple of HUD's seasoned housing counseling agencies.
Thanks again, Judy. We will now have a brief fireside chat with some agencies that provide counseling services in this topic area. Today, we are joined by Jennifer Fraser, Director of Stakeholder Engagement and Grants for Green Path Financial Wellness, as well as Jackie Boyes, Senior Director, Counseling and Counseling Support for Money Management International. Welcome to you both, and thank you for taking a moment to field a few questions about how you're addressing interest in housing counseling on the topic of refinance. Jennifer, I'll start with you, and if either of you have anything to add, just feel free to chime in. So, if I may, the first question is, what refinancing resources have you created either for your network or for your clients?
Sure. So in thinking about what we expect to come in the next year and mortgage rates lowering a little bit, we're expecting more refinance volume. So we've curated some resources for our counselors, we call them experts, and created some additional modules for our online training for clients to use and to beef up our training internally for our experts as well.
Excellent, thank you. And Jackie, a different question. Why should consumers work with a housing counseling agency when considering refinancing?
So just if you think about the content that you all have covered here today, there are so many ins and outs when it comes to refinancing. I think you said it's a big pond of options. And I think, consumers need to take a moment to step away from the lending side of the process and really work through this with a counselor. What we'd love to see in the industry is just a holistic approach to counseling in general. So you started out with a counseling agency or a counselor when you bought the home, and now you're looking at doing something different. Go back to that same agency, that same counselor, and have a new conversation. Just as you would if you'd hit a snag along the way and had an instability issue, you would have reached out to that counselor. So we love counseling to just be an ongoing engagement with consumers as they make these financial decisions.
Thanks, Jackie. Building off of that, Jennifer, what are the key things you'd like to make sure that the audience takes away from today?
I think some of the biggest things that we really need to focus on are clients' understanding of the total financial picture of what they're signing up for. The total cost is a big deal. You're entering into a brand new loan potentially for another 30 years. So the time frame and the new rate is going to make a big difference. Helping them look out for pitfalls to make good choices, help them understand if there are any prepayments or I'm sorry, any early prepayment penalties that they need to be aware of, such as repaying down payment assistance that was mentioned earlier. And also really looking out for just the true goal and need for the borrower, because there are a lot of offers out there that people are looking to get cash in hand and not necessarily understanding the cost of that cash in hand, both in their equity and the new cost of a new mortgage.
Excellent. Thank you, Jennifer. And Jackie, do you offer document review and product analysis as well as client budget analysis?
Oh, yes, of course. As part of any counseling session, of course, we're going through a really deep dive into that budget. And then we're going to talk about the documents that they brought to the session. Hopefully, they brought their lender's closing statement, so we can talk about the loan that they're actually looking to get, and then compare that to their other options, because that's the purpose of the counseling session. It's not just a sign off on the loan that you think that you're going to go for, but let's talk about all your options and make sure this is absolutely the best one. So having those documents with the loan terms and the details are perfect for this counseling session. And of course, if there are a variety of different pre-purchase, post-purchase kinds of sessions where you really can't complete that session without having those documents, so that you are really drilling down to what the consumer is looking at.
Thank you. And Jennifer, are there any concerns for what clients perceive as their needs versus the source solicitations that might tell them what they need?
I think, again, it's really learning what the client's need is. Sometimes taking advantage of your equity, which is something that we hear a lot, definitely also means loss of equity. Sometimes clients really want to get immediate access to that equity and that cash, and helping clients understand that using that equity, it should be taken well into consideration, especially if they're taking on additional debt. So we hear a lot that clients are looking to resolve other debt, consolidate other debt, but you do want to look out for and be a good steward to make sure that we aren't, supplementing vacations or going into debt more deeply versus doing something that's going to benefit the client.
That's great. And that actually leads into another question for either of you, which is really about particular areas that you're seeing coming up right now. You mentioned debt consolidation. Are taxes and liens or medical or student loans or other components showing up as a priority?
I think one of the things we've seen sort of trending is home improvement loans and home improvement refinance. It seems like some consumers are apt to stay where they're at, and that could have a lot to do with the availability of properties out there today. And so we're hearing a bit more from folks who want to enhance the home that they're living in. And in many cases, it makes total sense to refinance the loan that they have, assuming that they don't have one of those fabulously low interest rates, right, from 2021. But in some cases, it doesn't make a lot of sense. And so there are things a consumer needs to separate themselves from the excitement of, oh, I'm going to redo my house. It's going to be beautiful. It's going to be great. But do you plan to live there? How long are you going to stay there? Just common sense questions that it's good to sit down and have this conversation with a counselor about. Other than that, I wouldn't say that we've seen a lot of trends in any particular kind of debt itself, but we do see, as Jennifer mentioned, folks who are looking to refinance their home sometimes to pay off debt. we're not sure that that's really a good option always. In many cases, there are other ways to address debt rather than refinancing and taking out the equity that you have in your home. So it's just something we want to caution homeowners on doing.
Thank you. And lastly, do your work plans, your HCS, your website, and collateral materials reflect these service offerings?
I could take that. Our work plan does include post-purchase. I would say a lot of the conversations around refinance actually do come in more through foreclosure prevention channels, because they're looking at their options to give themselves more room in their monthly payments. So we do see it coming in both places. We are adding more information to our website, especially next year, to specifically talk about refinances. They're projecting much more refinance activity in 2025.
Fantastic. Thank you again, Jackie and Jennifer. This has been really informative and very reaffirming. For more information, we encourage you to check out GreenPath Financial Wellness and Money Management International websites. Judy, back to you for more resources and tools.
Thank you, Jason. Thank you, ladies. Great conversation. I think that was probably the most helpful part of this presentation. So let's go on to resources and tools. On this slide, you'll find 3 resources for counselors and their clients to use. Let's start with financial calculators. They're great tools to help clients determine affordability. There's educational material. Jackie and Jennifer shared some great ideas for educational material for both counselors and clients. And you can check out the HUD Refinancing Job Aid, which has been included in the documents for this webinar, and it can be found on the HUD Exchange as well. Lindsay mentioned it earlier today. There's also the Homeowner's Guide to Success, which was a group effort between HUD, USDA, VA, CFPB, and the Treasury, and it's a great tool as well. Workshops and seminars are great tools your agency could provide to your clients. There's also referral networks. The client may have a trusted lender, or you may want to refer them to one. Remember, if you're talking about products or lenders, you need to share at least 3 of them with your client. Local government and state opportunities could be available as well, as Jason mentioned. As a counselor, you should have knowledge of the programs in your areas, in the areas that you work. So moving on to the next slide, there's other resources that we've provided for you. Next slide, please. Thank you. First is a link to HUD.gov, single family, FHA refinancing. Each one of these links take you directly to the refinancing information for that specific entity. Freddie Mac, understanding your options for refinancing. Fannie Mae, mortgage refinancing options. USDA, rural development, refinance options for Section 508 direct and guaranteed loans. VA, Start My VA Loan Refinance, and CFPB, Should I Refinance Handout. I think that's probably a very helpful tool for clients. And now we're going to move on to question and answers. So now that you know everything there is to know about refinancing and have tons of resources, let's see if you have any questions. I saw quite a few questions come in while we were presenting. Lindsay or Shauna, do you want to bring those up? I think there's a few for Jason.
Sure, Judy. So one of the first questions we received was regarding slide 16. So I'm going to pivot back to that slide for Jason. And we're looking for clarification on this slide on the point you made, Jason, about VA and USDA loans.
Yep. So and I was about to try to write something, but trying to be succinct in comprehending all of this can be a little bit difficult because it feels like I may try to oversimplify it. In broader terms, what you will find is that through these 5 different program profiles is that when people are acquiring these loans, the LTVs tend to be in the 96.5, 97, and 100% range. When you're refinancing, the like effect is that you're not going to be able to attain more than the value of that home to that percentage amount. So even if you won't be able to refinance a Fannie Mae loan beyond 97%, and so therefore it doesn't necessarily down payment doesn't carry the same level of implication in that. So that may be where there was a little bit of poor clarification in that.
Thanks, Jason. Along those same lines, on this slide where you say when you say 5% funds for closing, what exactly are you referring to? Would closing costs not be financed?
Potentially. There's many of the things that our clients may wind up saying is that they can refinance without cost, but without cost just may be an indicator of direct out-of-pocket costs to be able to complete the transaction. But that does not mean that those costs may not be rolled into the loan and part of their new loan agreement. And so it may be subject to, if they can roll those expenses in, but the expenses are still there. Loans still have to be originated, title and or attorney fees still need to be tended to, and other comparable variables of what they found when they initially refinanced are going to come up. Some of it is even just the set aside of premiums.
Also specific to this slide, when will or does FHA do a streamline refinance over a regular refinance?
I'll broadly just try to say that it's going to be more reflective of whether or not additional documentation is required. So if there has been anything that has substantively changed in whether it's my income or credit or utilization or otherwise, some of those or value volatility, some of those components may trigger whether or not something can be done in a simplified manner like a streamline, or if additional documentation is going to be required.
Great. We have a question, which I think is relevant for potentially all of our panelists, and we'll start with you, Jason. Due to the job uncertainty and inflation right now that we're seeing across the country, are lenders tightening up their refinance options? Are we seeing trends where they're requiring higher scores or requiring first position along with second position? Obviously, this varies lender to lender, but we'd love to hear if there are trends we're seeing in this area.
I'd actually like to turn that to the broader audience before I respond. I do think, to your point, Lindsay, it varies. What we see coming out of USDA versus what we see coming out of Fannie, depending on regional implications, depending on housing typology and income tiers. It's a lot of different responses in my view.
Judy?
And I agree with Jason, definitely agree with Jason on that. I think it's all lenders are all, basically different in their determination, and in the area I think is really important as well.
The only other point I would want to offer is that the conditions of the market are potentially the greater concern than the client themselves. So it's not necessarily, viewing where their credit scores are. Sometimes it's a matter, and Jackie may even had hinted to this earlier, where some folks might have gotten into acquisition in the 3, 4, and 5% range, And yet today they might be looking at 7, 8, and 9, depending on what they're trying to achieve. And so the cost benefit may not be there either for the lender or the client.
We have a couple more questions, and we've received a lot of questions, which is great. We know this is a topic that's relevant, and further dialogue is always great on this topic. But first, to refresh for the audience, Judy, folks have had some questions about clarifying the tax implications of refinancing. Could you revisit that topic for us, please?
Sure. Not being a CPA, I can't really address a lot of the tax implications that might come up. It would depend, I think, on the property itself, the individuals who are refinancing. And I think it's just very important that they talk to a professional. A CPA or housing counselors aren't CPAs either in generally. And I think that it's important that they just at least talk to whoever does their taxes and just make sure that there's not going to be any issues. And Jason, I don't know if you've got any other thoughts on tax implications.
Yeah, I think it's twofold. One is that mortgage interest rate deductions that might be, kind of the core thing that people are attracted to at the onset of acquiring a home. And then as they look at refinance, as both Jennifer and Jackie were pointing to, if there's more home improvement type of intentions, the difference between doing cash out refis where you just want the money to go on vacation versus being able to make improvements to your home, those don't necessarily, they might both be $20,000. They might have different tax benefits. And so, depending on if we were looking at who's insuring these loans or guaranteeing these loans can impact a lot of how some of that might be viewed in the scheme of taxation. So I think to your core point, Judy, it's why, I don't think we're just trying to brush over the idea of you should speak to your tax professional, but you should speak to your tax professional.
Thank you both. We do have a lot of really great questions, but given our time, we're going to go ahead and pivot to our closing. So thank you all again. These were excellent engagement, and we're really interested in, as we see trends continue in the refinancing space, to continue the conversation with our housing counseling agencies. Thank you for joining us. As a reminder, this material is based upon work supported in whole or in part by Federal Award Number C23 TAVA 0011, awarded to ICF by the U.S. Department of Housing and Urban Development. The substance and findings of the work are dedicated to the public. Neither the United States government nor any of its employees makes any warranty, express or implied, or assumes any legal liability or responsibility for the accuracy, completeness, or usefulness of any information, apparatus, product, or process disclosed or represents that its use would not infringe privately owned rights. Reference herein to any individuals, agencies, companies, products, process, services, service by trade name, trademark, manufacturer, or otherwise does not constitute or imply an endorsement, recommendation, or favoring by the authors, contributors, the U.S. government, or any agency thereof. Opinions contained herein are those of the authors and do not necessarily reflect the official position of or a position that is endorsed by HUD or any federal agency. Our materials have been posted on the HUD Exchange. You can find us at hudexchange.info/counseling or email HUD at housing.counseling@hud.gov with more questions. And please remember to follow the link in the materials for the industry email sign up for OHC Gov delivery. Thank you all again for joining us, and happy holidays.